Welcome to the deep dive. Today we're putting Palo Alto Networks, ticker PANW, under the microscope. They just released their latest earnings.
That's right.
Our mission, as always, is to go beyond the headlines, really cut through the market noise, and pull out the most important insights for you.
Yep. Get you informed fast.
And with Palo Alto, the big question seems to be, can they keep up this really aggressive growth and stay profitable? Especially now, with the cyber threat landscape changing so fast.
It's the key question. And to tackle it, we've got quite a stack of material, the full Q4 fiscal 2025 earnings report, obviously,
Right.
but also market signals, what the analysts are saying. It should give us a pretty complete picture.
All right, let's get into it then. Unpack those core results for Q4 fiscal 2025. That period ended July 31st. What are the main numbers telling us?
Well, starting at the top line, total revenue came in at $2.5 billion,
Okay.
which is a 16% increase compared to the same quarter last year. So pretty healthy growth there.
16%, not bad.
Not bad at all. Now, where it gets a bit more nuanced is net income.
Ah, yes. The GAAP versus non-GAAP story.
Exactly. So the GAAP net income, that was $253.8 million, or 0.36 per share.
And how does that compare?
Well, that's actually down from last year. Last year was $357.7 million, or 0.51 cents per share. And they mentioned this was mainly due to certain costs.
Okay. A decrease on the GAAP side, but the non-GAAP.
Right. The non-GAAP number told a different story. It was $673 million.
Wow. Quite a jump from the GAAP figure.
It is. That's 95 per share. And that number is up significantly from last year's $522 million, or $0.75 cents per share.
Okay, so that GAAP versus non-GAAP gap, pretty wide. $253 million versus $673 million. All right. Why is that gap so big, and why should we care about both numbers?
That's a really important point. GAAP, generally accepted accounting principles, it's the strict standard way, includes everything.
Like stock compensation.
Exactly. Non-cash stuff like stock-based compensation, amortization of intangibles from acquisitions, things that can really pull down the reported profit on paper. Non-GAAP, though, adjusts for those. It tries to give you a feel for the core operational profitability. How's the actual business doing day-to-day without those accounting impacts?
So for a company like Palo Alto, growing fast, probably using a lot of stock options.
Precisely. The non-GAAP figure often gives investors, analysts, a clearer view. It shows they're still very profitable on that adjusted basis, even while they're pouring money back into growth.
Got it. So top-line growth is solid, non-GAAP profit is strong, even if GAAP is down a bit due to costs. That makes sense. But for a company like this, the real engine room is often the recurring revenue, right? The subscriptions, future commitments. That tells you about the future health.
Absolutely. Here's where it gets really interesting, I think.
Okay.
Their next generation security, or NGS, annual recurring revenue, ARR, that hit $5.6 billion.
$5.6 billion. And the growth.
Up 32% year over year. 32%.
Wow.
That's huge. It really signals, super strong demand for their platform. And crucially, how sticky it is. Customers aren't just trying it, they're signing up and staying.
That recurring revenue is gold.
It is. And then there's another big number, remaining performance obligation, RPO.
Right, RPO. Explain that one quickly.
Sure. It's basically the total value of contracts signed, but the revenue hasn't been recognized yet. It's future revenue, essentially locked in.
And that number was?
$15.8 billion.
$15.8 billion.
Yep, and that grew 24% year over year. So you've got this massive backlog of guaranteed future business. It's a really strong forward-looking indicator.
Okay, so strong current performance, very strong indicators for future revenue with that ARR and RPO growth.
Yeah.
What about their own forecast? What are they telling the market to expect next?
Yeah, the guidance, always key. So for the next quarter, Q1 of fiscal 26, they're forecasting revenue between $2.45 billion and $2.47 billion. That's about 15% growth year over year.
Still double-digit growth.
Yep. And non-GAAP EPS, earnings per share, between $0.88 and 90 cents.
Okay, that's Q1. What about the full year ahead, fiscal 2026?
Right, the full year picture. They expect NGS ARR to land between $7 million and $7.1 billion.
So maintaining strong ARR growth.
Yeah, that's projecting 26 to 27% year-over-year growth on that key metric.
Impressive.
RPO, they see hitting $18.6 billion to $18.7 billion. That's 17 to 18% growth.
Still building that backlog.
Exactly. Total revenue for the year forecast between $10.475 billion and $10.525 billion, roughly 14% year-over-year growth.
Right.
Non-GAAP operating margin, they're guiding for 29.2% to 29.7%. And non-GAAP EPS between $3.75 and $3.85.
Lots of numbers there, but painting a picture of continued solid growth and profitability.
Yes, but there's one more number in that guidance that really stands out.
Oh, yeah. What's that?
The free cash flow margin, they're projecting at around 38% to 39%.
38 to 39% free cash flow margin. That sounds high.
It is high. And importantly, it gets them to what people call the rule of 50.
Ah, the rule of 50. Growth rate plus profit margin, right?
You got it. In this case, free cash flow margin. So you take their projected revenue growth around 14%, add that projected free cash flow margin near 39%, you're well over 50.
And why is that such a big deal?
It's kind of a benchmark for high-performing software, especially SaaS companies. It signals really strong efficiency. They're not just growing, they're converting that growth into actual cash very effectively.
Which gives them options.
Exactly. Reinvest in R&D, make acquisitions, return cash to shareholders, all from a position of strength. It's a key thing investors look for.
Okay, so the numbers look good, the future commitments look strong, the guidance is solid, and they're hitting efficiency benchmarks. How did the market react to all this? What does it mean strategically?
Well, the immediate reaction was pretty clear. The stock, PANW, jumped about 6 to 7% in after-hours trading right after the report came out.
A decent pop. The market liked what it heard.
Seems so. And looking at it technically, the charts are showing some interesting things too.
Like what?
Analysts flagged that it had pushed through resistance around $180 and it's holding support above $165.
Okay, so finding a new floor.
Kind of. The next hurdle they're watching is around $205. If it breaks through that, some see potential upside towards $240.
Wow, quite a jump.
Yeah, and its relative strength score, RS score, is 83. That basically compares its performance to the rest of the market. 83 is very strong, confirms it's a market leader right now.
Any chart patterns?
Yep, it recently cleared what they call a cup with handle buy point near $195. That's often seen as a bullish sign for more upside.
But I sense a but.
Well, yeah. After this run-up, especially with that post-earnings pop, the technical analysts would say it's currently a bit extended.
Meaning it might be due for a pullback or at least a pause.
Potentially. It doesn't mean it won't go higher, but it suggests buying right at this moment might carry a bit more short-term risk.
Okay, so the market reacted positively. Technicals look strong, but maybe a bit stretched. Let's pull back to the why, though. Why do these earnings matter strategically, beyond just beating estimates?
Right. Because beating estimates is one thing, but why are they beating them? What does it say about their place in the market?
Exactly.
Well, first, as we talked about, that subscription momentum, the 32% growth in NGS ARR, it just hammers home that customers are buying into their platform vision and sticking with it. That's huge validation.
The stickiness factor again?
Yep. Second, the profitability. That non-GAAP EPS beat shows they can balance growth investment with delivering profits. On an adjusted basis anyway. It shows discipline.
Okay.
Third, that cash flow efficiency we just discussed. Hitting the rule of 50, that's proof of a really well-oiled machine, operationally speaking.
Right. Momentum, profit, efficiency.
But maybe the biggest piece is their structural positioning. Think about how cyber threats are evolving. More AI, more sophisticated attacks.
Exactly.
Palo Alto's whole pitch is about a unified platform, getting rid of vendor sprawl, companies juggling dozens of different security tools.
Which is a massive headache for security teams.
Yes, a nightmare. Palo Alto says, use our integrated platform, get a single view, automate more, react faster. In a world of AI-driven threats, that unified, coordinated defense becomes way more critical than just having lots of separate point solutions. It makes them a strategic priority for enterprises.
So it's less about just features and more about solving that complexity problem.
Exactly. And that, I think, really differentiates them. It also brings up, the bigger question of how all companies need to rethink security in this new AI era.
That's a great point. So wrapping this up, for you, the listener, digesting all this, what's the key takeaway? What should they consider?
Well, sort of two sides to it based on what we're seeing. You should definitely keep watching PANW if you're bullish on cybersecurity overall, especially this idea of platform consolidation and AI defense.
Because the fundamentals look strong.
Yeah, the financials, that recurring revenue growth, the solid guidance, it positions them as a really strategic player for growth investors in this space.
Okay, but what's the other side? The caution.
The caution is mainly around valuation and timing, I'd say. If you're expecting immediate multiple expansion, meaning the market suddenly decides to pay even more for each dollar of earnings, maybe temper that.
Because it's already valued highly and technically extended.
Exactly. It's not cheap, and it's had a good run. So maybe watch for pullbacks if you're looking for an entry point, or at least wait to see if it shows continued strength, confirming this leadership isn't just a short-term blip.
Makes sense. Watch it closely. Fundamentals are strong, but be mindful of the current valuation and technical picture.
That sums it up pretty well.
All right, so maybe the final thought for you to ponder is this. Considering how fast cyber threats are changing, and this push towards unified platforms we discussed, what parts of a company's health, financial, or strategic do you think are most critical for actually winning in the future of digital defense? Something to think about.
Good question to leave folks with.
Thanks for joining us on this deep dive.